on there.
Yeah, yeah, perfect. Okay.
And there we go.
Yeah, no,
Thanks.
sorry, folks. I was going to say, I suppose the presentation today, anyway, it is general information. So, following today, myself, Keane, or Louise, or even a couple of other advisors, will give you all a call because, again, we'll go through a couple of examples here on the talk, but they're very general. And as I said, everyone on the call today, you'll all have different levels of service. You'll all have different salaries. Everybody's circumstances is different. So, we'll give you all a call over the next day or two. And ultimately, we want to find out on that 5 or 10 minute call, does it make sense to book you in for an individual consultation? We'll always tell people there's no harm because they are complimentary and you don't get a lot of free consultations when it comes to financial advice, especially in the public sector. So we'll always tell people, have to sit down. You might not even know what you need or what you don't need, but we'll always say, have to sit down with one of us and we'll go through your own benefits then in a bit more detail. So yeah, in terms of Q&As, because it's such a big group and it's a lunch hour, we won't do a Q&A today, but you'll see now on the next slide going forward, there'll be a QR code. And I'll always tell everyone, scan the QR code and fill in your details because everyone that does, I suppose you'll get ahead of the queue for the call that you get off us. But it just means then as well, if you're jotting down any questions, you can put them in the book a call entry as well after you scan the QR code. So we'll do it that way if that's okay, folks. I'll crack on then. So yeah, as I said, just a bit of an introduction on ourselves. So my name's Dean Johnston. I'm with Cian Moody, as I said, and Louise Dunn. We're all financial planners here. Like that, anyone that doesn't know that the broker themselves, we're Irish Pensions and Finance. We do work with both public and private sector staff, but the main bulk of the work that we do is public sector. And I suppose the main reason for that, for anyone that doesn't know that's on the call today, is that we run one of the AVC schemes. There are only two payroll AVC schemes for the public sector, and we run one of them. So that's generally what we'll sit down with initially with people, and we're looking at the pension and what you're going to get as a pension. And if you're not happy or if you want to improve, that's where the AVCs come into play. And again, I'm not going to spend too much time. I know Louise is going to look after that, but there's a lot of benefits in doing the payroll AVCs. Saves you a lot of hassle in terms of claiming back tax relief and all that. But I'm going to leave that to Louise, as I said. Yeah, like that. We've a full team of financial advisors, not just us three. I think we've over 60 or 70 now financial planners for public sector staff, all experts. We're all sitting down with people 3, 4, 5 times a day. There's nothing we haven't seen now at this stage. And then like that as well, we've over 30,000 clients on the books, and we've recently reached 1 billion in funds under management. So I suppose it kind of shows people that, we've an ever-growing client bank, but more so to the point that the clients that we do have, they trust us with their money. When it comes to their pension saving, their AVCs, their investments, whatever it is, they do put the trust in us. But like that, it's all well and good of me sitting up here and talking about how good we are. But like that, the trust pile of scores, I think, speak for themselves. So we're at a 4.8 now. For anyone that's interested, you can have a look at the scores. There's plenty of good reviews on there. As I said, for today, 3 key things I'd like you to be getting out of the call. And as I said, you'll see the QR code there at the bottom. So the main scheme benefits. I know you all see the pension deduction on your payslip. You probably don't know exactly what it's covering. You probably know that you're going to get a pension. You might even know about the lump sum. I know a lot of people are looking forward to the lump sum, but there are some other benefits there with the main scheme. So I'm going to explain them in a little bit more detail for you today. AVCs, then as I said, Louise is going to look after that at the end. And then finally, what are the benefits of actually sitting down and having a financial consultation with us then? Okay, so this slide is one that we use for anyone that might be thinking, should I be sitting down? Should I be having a consultation? If any of these apply to you, generally would make sense to have a sit down and have a call with an advisor. So the big one that we always see up the top there is a shortfall in the main scheme benefits. So for anyone that's on the call and you're not aware, to have your full service at retirement is the full 40-year service. But again, most people these days won't actually have 40 years when it comes to retirement for a number of reasons. But like that, the following can apply to that. So if you're going to join the public service late, a lot of people are joining a little bit later these days. They might join in their 30s, 40s, even 50s. You're not going to have the 40-year service at retirement by then. Time spent working abroad, unfortunately, won't count towards your public sector pension benefits. A big one that we see then as well, I suppose, especially when it comes to women then, if maternity leaves or parental leaves come into play, if you job share or reduce hours. And I'll always say, for example, if someone is working part-time for 1 year, as in half-time for 1 year, you'll only have half of a year added to the pension. It's not going to make a big impact if you've only done it for a short amount of time or you plan to do it for a short amount of time. But if it's something that you have been doing or something that you plan to do in the future, it's always important to have a sit down and look at what the impact would be, because you might be in the service, for example, for 35-year service, but because of parental leaves or job sharing, you might actually retire with a service of 28 or 29. So we'll always tell people to have a sit down and have a look at that then. The next one we'll hear all day, every day, is if you want to have the option to retire early. I know that can be different for everybody. It could be 60 for one person, could be 63, 64. I even talk to people that are very optimistic and want to get out the door early 50s. I suppose the key word here is if you want to have the option. You might be working away and you might be getting close to retirement. You might actually say, I'm actually happy with what I'm doing. I don't want to retire now. But I suppose if you're sitting down and if you're putting financial plans in place in terms of possibly AVCs, that kind of thing, that will give you the option. So that's what we'll always say as well. The next one will tie in with the one above then. So if there's going to be a pension gap before the state pension kicks in, again, for anyone that doesn't know, state pension as of today kicks in at 66. Okay. And we'll always say as of today, because we don't know what's around the corner. It might be 66 for another few years, but like that, for anyone that's on the call, that might be 10, 15, 20 years plus away from retirement, that 66 could well be a lot closer to 70. So again, if you're on the call today and you don't want to be of the mindset that you're going to have to work on close to 70, have a sit down and have a look. Because again, you might want to retire at a 65 or 64. You'll get your pension from the job, but you might have to wait a few years until you get the state pension. So always important to have a look and see what impact that's going to have. The next one then as well. So look, these are all things that will happen throughout your working career, throughout your life. If you're, having children, you're getting promoted in jobs, that kind of thing, you're getting married. All of these things will have an impact on your financial needs, and things will always change. What you need or what you don't need today might change in 2, 3, 4 years' time if you're having kids or you want to save for children's education, or as I said, if you just want to maybe have a little bit more money in retirement. We'll always tell people have a sit down if these things apply to you as well. Last but not least, then as well, and this is a very important part of when we're sitting down with people, is in terms of savings and investments. And we'll always say, if you do have any concern, if you're saving a bit of money now at the minute, and we'll always say, if you don't plan to access that money, even for a minimum of 5 years, we'll always tell people, don't leave it where it is now at the minute. Generally speaking, most of us, 99% of us, if we don't know what to be doing with it, we'll have it saved in the bank or the credit union or the post office, which is great because you've done the hard part. You've been able to save it, but it's not in the right savings vehicle. Because as we well know, with the way inflation is and the cost of living, if we have €100 saved in the bank today, if we're taking it out tomorrow, we're pretty safe. It's probably still €100. But if we're not accessing that for 6, 7, 8 years, that €100 realistically might only buy us what 60 or 70 buys us today. So we'll always say, if you are saving a bit of money, or if you plan to start saving a bit of money that you don't want to actually access in the next couple of years, we'll always say have a look at your options. And that's where we'll usually look at, regularly investing your money, whether it be a lump sum or on a regular basis as well. So yeah, as I said, there are some of the main reasons. Again, when we're sitting down individually, we'll be able to look at that with you in a more in a bit more detail. When we're looking at this slide, then, so this is the superannuation scheme slide, and this is basically everyone on the call today will have these 5 benefits in place in some shape or form, depending on the pension scheme that you're on, though, because there has been 4 different pension schemes. So everybody's pension scheme will vary a little bit, but generally speaking, you will have all of these benefits in place in some shape or form. So I suppose I'll start off by going around and showing you what's in place as it is. And then I might come back around then again and say, well, look, if you're sitting down for a consultation, this is how we might be able to help. So again, the pension is the first one. That's basically your income that's going to pay you from the day you retire up until the day you die from the job. As I alluded to before, the best possible case scenario for in terms of your pension income is if you have your full 40-year service. If you have less, it gets reduced then accordingly. So we'll show you those figures actually on the call. The lump sum then as well, if you were lucky enough to have the full 40-year service at retirement, you get a lump sum of 1.5 times your salary. And that's the best possible lump sum you can get. It is tax-free. So I know people are usually looking forward to the tax-free lump sum. Again, anything less than 40-year service, it gets reduced accordingly. The next couple of benefits then as well, maybe not as well known. I know some people might know them on the call, but generally not as well known. So the illness benefit then, and I suppose in terms of there's actually 2 illness benefits. The first one is while you're working. God forbid, you go out of work sick tomorrow and you're out of work you're out of work long term. The job would pay you, the first 3 months would be full pay, and the second 3 months then would be half pay. So it's really good short-term cover there as a public sector employee. As I said, first 3 months fully paid, second 3 months half paid. But what we usually look at then on the consultations is, because it can happen, we don't want to be, too negative, but in the event that you're out of work kind of longer than 6 months, we have a look at the implications on that as well. Because generally speaking, the only income that you'd have would be the state illness benefit at that time. And that's a little over €250 a week. So again, the usual question that we'll ask, I know Louise and Keane will be the same. Would it be a struggle if you were to lose your income and you're down to 250 odd a week? Most people will tell us yes. And if that is the case, that's where we'd be looking at the likes of income protection. And for anyone that doesn't have it on the call, the income protection just basically allows you to still have an income coming into you while you're still off work sick. And if you are off work for more than 6 months, for example. The next one then is the death in service. So again, God forbid you pass away while in employment in the public service, there is a lump sum of money paid out to your family. I do usually get asked, do I have to be married or do I have to have children? You don't. It'll go to your estate anyway. And I suppose depending on the pension scheme that you're on, it'll be anywhere between 1 times your salary as a lump sum up to 2 times your salary as a once-off lump sum as well. And then finally, kind of ties in with the previous one, spouse and children's pension. Obviously, you do have to be married or you do have to have children for this one to be paid out. But essentially, any spouse, any surviving spouse will get a portion of the pension that you would have got at retirement for the rest of their life. And then if you do have any children, it'll actually pay them a portion of your pension up until they turn 18. Or if they are in full-time education, it'll be up until 22, I believe. So the children's pension does obviously end at some point. So as I said, that's what's in place in a nutshell. I know it's fairly general. We will be looking at it in more detail when we sit down. But I suppose in terms of how we then look at the situation and how we base the calls, we might do a multi-call approach. Sometimes we might sit down with a person for one call. Sometimes it might be 3 or 4, depending on what the needs are. But generally speaking, on call one, we look at the pension and the lump sum. We'll show you your figures. What do we think? Are we happy? If we are, great. We don't need to do anything. If we're not, that's where we look at the AVCs and the benefits of doing that. Then if we look at, say, a second call, that's where we might look at the illness part. So we might look and say, okay, well, look, this is what would be the situation if you're out of work sick long term. Do you feel that you need more cover there? And if you do, we can look at the likes of income protection or possibly then life insurances as well. And then finally, as I alluded to in the previous slide, with the savings and investments, if you feel that you want to start saving your money for medium or long term, that's where we can look at that as well. So as I said, it just really depends on your own situation on how many calls that you might sit down with us for. Just moving on then. And I think, am I moving over to you now, Keane? Is that me done?
Yeah, that's me, Dean. Thanks very
Yeah,
much.
lovely.
So thanks again, folks. I'm not going to give an introduction every time we swap over. Dean thankfully did that for us at the start. So, look, I'm just going to give you an idea here on this slide as to what to expect at retirement. All right. Now, look, we're very aware that there's a lot of people on the call, different departments, different service, different salaries, etc. So, look, we're not going to be able to go through individually with everybody today. But again, as my colleague Dean said, look, that's something that we can do with you on a consultation on a one-to-one basis. So again, if this is something you're interested in, the QR code's up there. Feel free to scan it. All right. But this is just to give you quite a general idea of what to expect at retirement. All right. So what we've done here is we've taken somebody who works in the public sector, like yourselves. They earn €50,000 at retirement and they have full service. All right. So that's a little something that Dean touched on earlier. So just for the basis of this, you have full service. All right. So there's a couple of different schemes available in the public sector. All right. So the first one we're going to go through is the first scheme that was available in the public sector, and it's for anybody that joined before the 6th of April, 1995. All right. You'll know you're one of these people if you see on your payslip, your RSI stamp will be D1 or B1 usually. All right. Um, this one for those of you on the call, you might be leaving this call a bit smug over your colleagues, right? We sometimes jokingly say this is the Rolls Royce of the pensions, all right? But look, the reason we say that is it is the best public sector pension, but that's not to say the other ones are bad, okay? So with this scheme, right, if you have full service at retirement, you'll receive half of your income as your pension, All right. So in this case, this person earned €50,000. They had full service at retirement, so their pension's going to be €25,000 a year. All right. And then that's all paid by your employer. So quite straightforward, right? Where things change a little bit then is when we move on to the other schemes. So the next scheme is anybody who joined after the 6th of April 1995, but before the 1st of January 2013. All right. Why this changes a little bit is they now introduce the state pension as well for public servant workers. All right. So you'll still get your pension from the job, but it's at a reduced capacity, but you'll get the state pension as well as that. So if we took the same example, €50,000 at retirement with full service, the pension from your job now is €11,205 a year, but you will get the state pension on top of that. And as my colleague Dean alluded to earlier, we'll usually go through with you what the state pension is worth today, but look down the line, it might be something different. So it's just always making sure that we're planning as best as we can. Okay. The last scheme then is anybody who joined after the 1st of January 2013, right? So if there's any new entrants or anything like that on the call here today, this would be most of you guys. All right. So things change a little bit again. All right. And why they change is you still get your state pension and you still get your pension from the job, but how the pension from the job is calculated is a little bit differently. All right. They're taking an average of your career earnings, where just for easiness sake, the other two schemes, they essentially would take your best salary, but for this one, they'll take an average of all of you of what you've earned over your career. All right. So again, you've done absolutely nothing wrong than the previous schemes. It's just when you joined, if you had the same as the other two, 50,000 at retirement with full service, your pension now from the job is looking more like about €7,500 a year. Okay. So that's why we say the first one we sometimes refer to it as the Rolls Royce. Okay. It's shown like the pension has changed as time has gone on. Okay. So again, it's not bad news. It just means that make sure that we're sitting down and we're planning for it. Okay. Next slide, please, then. And I'm going to talk you through the lump sum. All right. This is actually quite straightforward, so I shouldn't need to spend too long on this. If we take the same example from the previous slide, all right, somebody who earns 50,000 at retirement and they have full service, if you joined before January 2013, all right, so everyone before that, if you have full service, you'll receive 1.5 times your salary as a lump sum. Okay. And as Dean mentioned earlier, a lot of the times that will be tax free. Now there is limits as to what that is, but look, we'll be able to show you individually if there's any issues there with tax. Majority of the time that'd be tax free. Okay. Then look, this the you can see that there in the purple box. If you look at the green box, then this is just to give you a very brief idea as to how service can affect your pension. All right. So if we take that same example, but instead of having full service, they have half service. So in this case, it'd be 20 years instead of 40. The lump sum that they'd be expected to get is 37,500. So it's half of what you would have got if you had full service. All right. Now, again, look, there is ways that we can always make sure that we're getting our maximum lump sum. That's something that my colleague Louise is going to chat to you about in a couple of minutes. But again, just tying it in, it's just to make sure that we're sitting down. We accept that this is the case. Right, what do we do next? Okay. And then for anybody who joined after 2013, still actually technically 1.5 times your salary. But again, you'd be expected to probably come out with a little bit less in around €60,000 in this example. Again, just because how they're calculating that salary, you're always fighting that averaging system. All right. Next slide, please, Dean. So your pension number. All right. So this is something that we'll look at with people individually. All right. But if you feel like you want to book in for a call with us afterwards, this is something that I'd be thinking about between now and then. Is what category would I like to fall into? And then when we sit down with you, we'll be able to see what category are you in currently. All right. So we've three pensions here. You've got modest, moderate, and comfortable. Okay, so the first one, a modest pension. We say that if you have 30% of your current income, that should give you a modest pension. What I mean by that is you'll be able to cover the basic needs, and you won't really have much left over for non-essential. So you'll get by. All right, you'll be able to survive. All right. Um, That's if you're sitting at 30% of your working income. Then if we move on to our moderate pension, this is half of your current working income. Okay. So what we mean by a moderate pension is you'll be able to cover your basic needs and you'll have a bit more flexibility and you should be able to have a financial safety net. God forbid something unexpected was to happen. Okay. And just on that note as well, right? This is really important. A lot of the time we think now about making sure we have our safety net, we have savings in the bank. God forbid something was to happen. But people, when I'm sitting down with people, they seem to forget that that's maybe even more important in retirement. Okay. If something was to happen with your health, etc., you're probably more likely it's going to happen in retirement. Like I'll give you as an example. All right. I had a client of mine. I actually met her through one of these webinars. We sat down over the years, we built up her pension, and we got her from this kind of this 30% more into the 50 to 70 range. All right. She retired, she's enjoying her retirement, and then look, I mean, she was fine, but her mobility changed a little bit. She wasn't able to get around the house as easy as she was before. But everything was fine. She just had to get a bit of work done with the house. Thankfully, she had money built up in her pension that she was able to pull from that to help with those expenses. But if she was still sitting at that 30% of her working income, that's probably a different story we're going to have altogether. All right. And you can imagine, if you can do it now on 100% of your income, or you might even say it's a bit of a squeeze, you can imagine trying to do that on 30%. All right. Then the last one is hopefully what everybody wants in retirement, all right, is your comfortable pension. So we say 70% of your working income will give you your comfortable retirement. So what we mean by that is you get your basic needs, you have your financial safety net, and now it's time for you to enjoy a bit of that money you've built up over your whole life. All right, whatever that might be. Look, we'll ask you. All right, so have an idea as to what you want to get in retirement. Do you like to go traveling, spend time with the grandkids, whatever it might be? Everybody's going to be different. All right. Um, but as well, something just to mention outside of the luxuries, I suppose, especially with that 70% comfortable retirement, what this is also doing is it's protecting you from inflation. Inflation is probably one of the biggest threats to people in retirement because if you're sitting at 30% of your income and that gets you by now, and inflation keeps going the way it is, that doesn't mean that in 10 years' time it's going to get you, excuse me, it's going to get you the same amount as it does now. So it's just to make sure that we're always planning for that. And again, look, Louise will touch on a little bit how you can do that. But guys, look, what I'm really trying to get at here is it's the most important thing is figuring out where we are now and where we want to get to. We can always get you there in between. All right. Next slide, Dean. Right. So this is actually a relatively new slide that we started to do with some new figures that have come out, right? And it's the difference between men and women's pensions. All right. And Dean actually touched on this a little bit earlier. So by no means is it to say that, if you're a man, your pension is miraculously fine and you're grand. It's more just to say how women are really at more of a disadvantage. All right. It's not to say that men's pensions are fine. It's just women in general tend to be a little bit worse off. And I'll show you why here. All right. So with this slide, I'm just going to go through the facts, which is all right. So first one here, right? On average, women have 36% smaller pension pots than men on average. All right. Now, why that might be, Dean, as I said, mentioned earlier, is generally due to the service. All right. So, for example, here, years working, right? Again, this is all on average. Women spend 7 years fewer in paid employment than men, usually to do with maternity leave, caregiving, having children, etc. Okay. As well, what kind of leads into that as well is we often see women go part-time as well. So to show you the difference, 23% of women will work part-time at some stage in their career compared to only 7% of men. Okay. And then when we're leading that into the pension, then, all right, in order for a woman on average to have the same pension pot as a man, they'll have to work 8 years longer. All right. And then just to make things even better, some good news for the women on the call here. All right. On average, you're still living about 3 years longer than us. All right. I don't know what that says, but they're the facts. All right. So again, it's just making sure that, we have to accept the facts. If you're living longer, you're going to need a pension for longer. All right. And this last one here is the one that really sticks out to me. Okay. Women are 50% more at risk of poverty in retirement than men. All right. If that's not a fact that sticks with you, I don't know what is, right? So again, as I said, just to reiterate here, it's not about, men's pension pots are fine. It's just about accepting the facts. You have to, let's be real, we're all working here to enjoy our lives, have your life, provide for your family. So you need to do that. But it's just accepting the fact of, right, well, we need to sit down and plan for it. And again, if that's something that you're interested in, whether it's the pension or the savings protection, scan the QR code. You'll lose nothing by sitting down to us and figuring out your situation. All right. Next slide. Yeah, and this is my last slide here. It kind of leads into what I was talking about with the pension. All right. So this is some statistics taken from the CSO, so the Central Statistics Office, about somebody in retirement in Ireland last year. All right. So the average outgoings. So if you have a look here, right, this is fairly normal person like you or me. I would say, their household bills, gas, electricity, internet coming at €2,000 a year, health insurance, €1,900 a year. You look at their car, it's tax, repairs, insurance, €1,800. I don't know where they're getting that mechanic from. Hopefully they can put me onto them with that price. And then look, your couple of holidays, bit of savings. Okay. €35,000 in today's money is that's what that's costing for somebody in retirement. So like if we thought back to those examples I've given to you there, somebody with full service earning €50,000, and we jokingly said, the Rolls Royce pension, that was €25,000. This is €35,000 is the average outgoings. Okay. And again, touch on something that I said a minute ago is this is in today's money, right? If things keep going the way they're going, I wouldn't be surprised, 10 years time, this is €45,000. So again, that inflation risk is one of the biggest threats to somebody in retirement. So we always need to make sure that we're saving in the right way so that we're at least in line with inflation and hopefully beating it. Okay. But look, the idea of this is just to give you an idea of, this you can find this on the CSO's website. This is what it cost to live as a retired person in Ireland last year. So you might be thinking, right, well, what can I do about it? Okay. And that's what my colleague Louise is going to chat to you about now. All right. So thanks very much, everybody.
Perfect. Thanks very much, Keen. I feel like this is the part everyone's been dying to hear, so can't wait to get into it. But look, I really don't want to overcomplicate these things too much, guys. Some people on the calls may already have additional voluntary contributions, so that is literally what AVC stand for. You may already be paying into them. You may have been paying into them before. You may be toying with the idea of paying into them, or you may be on this call. I've never heard of them before. Okay. Basically, additional voluntary contributions are a very simple way of paying extra into your public sector pension. Okay, so whether you're someone on the call in one of the departments, in the HSC, and Garda Síochána, everyone has a way to pay through their payroll to put extra into their payslip. Okay, you can see here it's a very tax efficient way for people to put money into their pension, which is what most people love about it. Okay. 99.9% of the times, it does make sense for everyone to be paying into AVCs. But as the lads would have mentioned earlier on, we will sit down with everyone and make sure we recommend this first. So we're not saying that it suits everyone. It's our job as financial advisors to make sure we sit down and make sure it does make sense for you first. But if you think it does, definitely scan the QR code, get ahead of the queue, we'll sit down and we'll have a little look. Okay. So they're a way of you boosting up your benefits, literally exactly what Dean mentioned earlier on. So if you have shortfalls, you can use your additional voluntary contributions to enhance stuff like your lump sums if you have shortfalls, or to touch base on what Keane said. If you're someone and you don't like the looks of the income that you're on, so you sit down with us and maybe you have the Rolls Royce pension and you don't want to live on 25 grand a year, you can use it to enhance your income as well. Okay, so it's for everyone, not just for people with shortfalls. They're literally a way of you saving money very tax efficiently and having a better income at retirement. And to be quite honest, for any of my retired clients, I've never heard any of them moan about having too much money. I think Keane and Dean can agree there. If anything, they're happier with a bit more extra cash in their pocket. Okay. Little example here below. So basically, this is based on someone who is a higher rate taxpayer. Again, we will look at everyone's tax on their pay slips. and make sure we go through this first. But this is just an example. If you are someone that is paying a higher rate tax, you get higher rate tax back. Okay. So this is an example. If you were to put €100 in to the AVC, so that's what you can afford and what's comfortable, you get €67 in with it from tax relief or from your PAYE on your payslip, and 167 goes into the pot. Okay. A lot of people, when they realize this, it's a no-brainer. They're like, never heard, never, can't believe I haven't been doing this for years. Okay. If you are saving for retirement to the credit union for the next couple of years and you're going to put €100 into the credit union, it's going to be €100, maybe €100 with tiny 1% because interest rates aren't great. But if you're putting it into an AVC to your payroll and you're a higher rate taxpayer, you're getting €67 straight away on top. Okay. So absolute no-brainer when it comes to savings, guys. It's the best savings schemes we have in Ireland. Majority of people that want to make a bit of money for retirement, they will put it through a pension. Okay. Next slide, Dean.
Yeah.
So how do they work? Okay. And again, we will go through all this. But as Dean mentioned at the start, the reason we come in and we do the group talk and you guys sit down with us is we actually have the payroll scheme for you guys. So very, very handy. You don't need to be messing around claiming tax relief off revenue. You don't need to be going contacting any one of your employers. We do it all for you. We sit down, we basically run it through your payroll, you get your tax relief at source, and all you're ever paying is that net amount. Okay. You can make regular lump sum contributions, which means you can do it on a weekly, fortnightly, monthly basis, whatever way you're paid. Or if you have a bit of kind of cash built up and you haven't been doing ABCs, you can actually put a lump sum into your ABC fund against last year. Okay. This is again always a really nice one for people that, as Keen mentioned, have money sitting on deposit there. If you don't want to be leaving it for a longer period, at least look at putting it into your ABC fund and you can claim some tax back on last year that realistically you're just going to lose out on anyway. Okay. Range of investment funds available. So this is always a nice one to look at. So I suppose when it comes to your pension, we can look at numerous ways of actually investing this, and everyone is different. So it's our job to kind of go through that risk assessment with you guys and see what way you want your AVCs invested. Okay. They do have to be invested at, somehow, because at the end of the day, if you're not retiring for another 10, 20, 30 years, as Dean mentioned at the start, you don't want your money devaluing. Okay. Revenue approved, still saved by public sector employers, which is why, again, we are allowed to come in. Okay. Charges on an AVC. With every pension policy, you are going to have charges. Ourselves and Irish Pension Finance are very transparent when we sit down with you and we go through exactly what that is. Now, the good news is you don't actually ever pay anything physically. It's all run through your contributions and it's built into the projected fund. But we like to be really transparent and show you kind of how it works under the bonnet. Okay. Either way, for everyone to sit down with us when we give you a call after scanning that QR code, there's absolutely no consultation fee for you to sit down with us. So if you sit down with us and maybe AVCs just aren't for you, that's absolutely fine. Okay. Next there, Dean.
Yeah.
So that's kind of the ABC side of things. But as Dean and Keane would have mentioned already, is that we look through a lot of, we sit down and we deal with a lot of other stuff. So we don't want to be known as pension people at the end of the day. We are full financial advisors. It's our jobs to make sure that you guys in the public sector are fully financially secure. And what that means is we look through everything. So a few other benefits that come along with that is basically, well, number one, over 30 years experience. So we know all your benefits. So Dean already talked about some of them to start, not just your pension, but if you were to pass away, what's there for your family, what's there for your kids, what's there for your spouse. If you were to get sick, how can we help you there? So we know your scheme inside out, unlike some other financial advisors. Okay. Exceptional service. So we have highly trained and qualified financial planners. As Dean mentioned, we have probably 60 plus advisors now in the company, all fully qualified. Okay. Reviews are offered on an annual basis. So I think with some financial advisors, might set up a plan and that's kind of it. Happy days, maybe see you at retirement, if even. Okay. We will contact our clients like yourselves once a year to make sure that you guys are being looked after every year. It's your money at the end of the day. You should be involving in a annual review with ourselves to make sure you know what you're on track to receive, but also your salary changes, life changes, goals change in terms of finances. So it's our job to help you with them. Okay. Webinars, literally like this one, okay? So not only just for cross normal public sector, we have kind of specific webinars every now and again. So people that are really close to retirement, we have investment webinars, we have ones particularly maybe for doctors, etc. Okay, and these are all completely available and free of charge as well to watch. Service centre phone line, this is a nice one. So basically we have kind of like a reception line. Now, when you pick up that phone, there is always someone qualified on the other end to help you out. So you're not going to be left with AI or a robot or someone who has absolutely no clue about what they're doing. It's always going to be someone who's qualified, which is really nice. Okay. Bespoke retirement glide path service. As I mentioned already, it's not our job just to meet you once, set you up a policy, and off you go. When you retire, we really like to take care of you in that year. So when you're just about to retire, when you're retiring, and after retirement as well, we're going to make sure we look after you after retirement because life doesn't just stop just because you've retired at 60 or 65. We want to make sure your finances are still kept in order and we kind of still help you with your goals. Okay. And retirement help desk as well. Independent advice. So at the end of the day, look, we are our own financial broker. We are not tied to any one company, which is really nice when you're looking at the likes of, say, income protection, life cover. We can basically shop around for you. We can go with maybe who we think would be best suited for you, recommendations, but also in terms of a value wise, we can see maybe look up kind of quotes and see what matches your affordability best. No fee to speak to a financial planner. No need to be a member of any union, which is really an important one. Okay. So if you're someone that's not paying into the union, that's absolutely fine. You don't need that to have the AVC scheme through your payroll. Free additional life cover of €10,000 for AVC members. Free risk assessment service to help you find the fund that best suits your needs. So not only for the AVC, but if you're looking at savings and investments, we are not just going to recommend anything just because we think it's good, we think it's doing well. It's there to match whatever you come out as. Is that okay? Next one there, Dean, I think we're almost finished. Okay. I just kind of want everyone to concentrate on this one, just even for a moment. This is a really, really important one, and I think it's really hot, like a hot topic today because we're all very aware of how inflation works. The lads mentioned it already. We're all very aware of the interest rates. I think, a lot of people these days, I meet anyway, we go on the calls and people are like, oh, well, I just have my money in X, Y, and Z. And they know straight away the interest rates are 1.5, 2% if you're lucky. Okay. So it's not to say that it's any bad time to start, but the sooner you start, the better your money will grow because your money is growing in terms of like investment rather than just sitting in the bank or the credit union. Okay. Either way, when it comes to an AVC or any kind of savings, it's never a bad time to start. You can see you're still going to make more money than if you were to do nothing. But if you start sooner, your money is definitely going to grow. Time's your friend when it comes to investments. Okay. You can see if someone started under 30s, putting kind of the same amount in over a larger period of time, you can see they're obviously going to come out with a lot more money. Okay. So a lot of young people these days, they are a bit more conscious of putting money into their pensions, but there's still that, "Oh, I don't think I need to yet." But at the same time, maybe we should because putting in a smaller amount now that's affordable, down the line, you'll thank yourself, especially if you need to pull back. You get a mortgage, you have a family, you can't afford it then. But if you can afford it now, start putting it in. Let the money work for you. The money will sit there invested really nicely, guys. And just for anyone, we again will go through all this, but for anyone that's kind of that knows a little bit about investments and stuff in Ireland, it's any pension funds, they actually all grow dirt free. So there's no exit tax on any of the money you make. So the more money you make, the better basically. Okay. But that kind of comes into savings as well. So if you're someone that's been toying with the idea of setting up children's savings, or even just some savings just for, 10 to 12 years rather than 30 years, have a chat with us. Okay. Even if maybe the pension's not your main aim, if you want to get savings going for the kids, putting money away that's been sitting in the bank or the credit union for a while, have a chat with us. You can see right in front of you. There's definitely a reason why you should be doing it now rather than later. Okay. I think one more slide. Perfect. This is just a quick one, I suppose, because as I mentioned already, we don't only deal with pensions, but like if you're someone that's been kind of, looking at maybe income protection or life cover, like obviously what we're going to do, and the lads already touched on, is we're going to sit down and go through what you have in place if anything happened to yourself, if you got sick. But if that's not enough, we might need to look at something like this instead. And it's a really nice product that Aviva have, and we can look at all this individually anyway. But if you're someone that does have, say, a family at home and you're the main earner, and if you went out sick or you passed away, and what the public sector has in place for you wouldn't be enough to help your family keep going on, you might need to look at putting something extra in place. Okay? Don't worry, we can help you with that. Is that okay? Perfect. One more, and then we will be wrapped up. Okay. So again, look, Dean touched on these at the start, but he did go through the main scheme benefits. So I really hope everyone has came away with today knowing what you have in place. Okay. Now, just because Dean went through them doesn't mean that's exactly, what you might have. So your pension, your lump sum, your death and service, he went through that on a more general basis, but we can calculate all five of them for you, each one of you guys. If you scan that QR code, get booked in with ourselves, we can calculate every single benefit available to you. Okay, so you get a much more better understanding from today of where you are at. AVCs, hopefully I went through them okay. And again, look, you still might not be too sure after today's webinar. So please just book in for that free of charge consultation. Let us go through with you and we can explain if they're going to be beneficial for you or not. Okay. Benefits of financial planning. Again, all three of us would have gone through a few bits there. So not only just sitting down and looking at your pension, sitting down and looking what you have in the background, how to protect you and your family financially if anything was to happen to yourself, an illness or health, but also then savings. Okay. One thing I think we forgot to mention as well is a lot of people in the public sector now came from private employment. So if you're someone that has been in private sector employment or has a personal pension set up, that's definitely something that we can help you with as well. Okay. So it's something you can bring to the appointment with us and we can go through that. Okay. But again, if there's anything we didn't go through, I know we went through a lot, please scan the QR code, get booked in with ourselves. You'll kind of go to the top queue then. But for anyone that didn't scan the QR code, we will be able to contact everyone regardless. But people who scan the QR code will get kind of top pick then. Is that okay?
Yeah,
Dean,
brilliant.
anything to add?
Thanks again, everyone, for joining in. Apologies about the technical difficulties at the beginning, and if it kind of continued on for you. But as I said, we'll give you a call anyway, and we'll go through everything. I know it's close to 2 o'clock, so we've nearly had you for the hour. But again, thanks everyone for coming, and we look forward to speaking to hopefully everyone that's on the call over the next couple of days.
Yep. And I know there was a few kind of extra questions there. So look, any questions that are there, please just kind of jot them down, keep them. Myself, Dean or Keen will be more than happy to answer that them when we give you a call to get you booked in. We'll go through everything in
Mm,
terms of fees for AVCs or any additional life cover then as well. Is that okay?
brilliant.
Guys,
Thanks
thanks
again,
so
guys.
much for joining today.
Thanks,
Have a
everybody.
fantastic day. Thank you.